Hi there, welcome to Kneppy Invest. In 2014 or 15, I probably would have called Ramsay Health Care one of the highest quality companies on the ASX. I probably don't think that anymore. I was a shareholder of this company, but then I sold out of my shares quite a few years ago. And recently, in April, there was a takeover bid for the company. So that was 5 months ago. And we have seen some updates in regards to this potential takeover bid for Ramsay Health Care. And we did see the share price drop 10% a few days ago because the updated takeover proposal wasn't that favorable. And one of the reasons it wasn't that favorable was because the consortium, KKR, who is looking to take over Ramsay Healthcare, did not really like the financial year 22 results from the company. So in this video, I'm going to look over the financial year 22 results from Ramsay Healthcare and also go through the takeover history since April of this year. This is the long-term chart for Ramsay going all the way back to 2007, and from about 2010 all the way through to about 2016-17. This was a fantastic company to own. Share price actually increased from $10 to over $70, so a seven-bagger for those who held during that period. So in about 2013 or 14, when I bought into Ramsay Healthcare, that was the time I thought this was one of the highest quality companies on the ASX. But just because a company is high quality at a certain point in time doesn't mean it's going to remain high quality forever. Things do change. And we have seen share price just go sideways over the past 5 years. And the reason the share price has gone sideways is because this company isn't really growing, or if it is growing, it's not growing all that much. And the other thing to take into account, if you go back to about 2015-16, there was a premium to these companies' shares because of that perception of the high quality nature of this company. On the 20th of April, Ramsay Health Care share price popped up because there was this receipt of non-binding indicative proposal from a KKR, the consortium, to acquire 100% of the shares of Ramsay. And it just mentions here that Ramsay shareholders will be entitled to receive $88 per share, less any sort of ordinary or special dividends, which wouldn't be all that much. So you would have expected the share price of Ramsay Healthcare to shoot up to under $88. So somewhere between $80 and $88. And that's exactly what it did. So usually when I am holding a company's shares and there is a takeover bid for that company, I will sell out soon after there is that receipt of this proposal. So if I was a shareholder of Ramsay, I probably would have sold out fairly close to 20th of April to take advantage of the share price increasing, because moving forward, a lot of times you will see these sort of takeover bids not be followed through. They will not go on. They will fail. Sometimes you will see further bids put in by other consortiums, and that's a way the share price can increase. But on average, I have found over time that when there is that initial takeover bid, that is a time to take advantage of the share price increasing, because a lot of times these takeover bids do fail. After the takeover bid of Ramsay, I wasn't really following the share price all that closely because I expected there was that potential, pretty high potential, that this was going to be a successful takeover bid. But after a while, I noticed the share price was dropping and dropping. And in fact, the share price dropped below $70, and I was becoming interested, not really in taking a position in Ramsay Healthcare, but I was realizing the market wasn't that confident that this takeover bid was going to pass, wasn't going to be successful. And then on the 25th of August, there was an alternative proposal from KKR, and shareholders would have been able to elect to receive 100% cash consideration of $88 per share for their first 5,000 Ramsay shares. And then in excess of that 5,000 shares, Ramsay Healthcare shareholders would get $78.20 in cash and approximately 0.22 Ramsay Santé shares. And the Ramsay board said that this alternative proposal was inferior to the consortium's indicative proposal of $88, their first proposal. So this was not a good sign moving forward. The market didn't really react to this update on the 25th of August, but they definitely did react to the next update, which was, if I remember correctly, on the 13th of September. And this was the update released on the 13th of September, and the market did not like this update. And understandable. I'll talk about why in a second. Share price dropped 10.35%. In fact, share price dropped below $60 at one point in time, $59.97. And $60 is a really strong support level. So that could have been a good time to take a position in this company if you think that this company is undervalued. But there is a reason why the share price did drop 10%. And really, there's a couple of comments within this state in this announcement. For instance, that the consortium notes that it is not in a position to improve the terms of the alternative proposal. And again, remember, the Ramsay Health Care board thinks this alternative proposal is not better than the first proposal, it's inferior. And the consortium recognizes that further engagement and access to further due diligence may provide some positive visibility. The information provided in the financial year 22 results implies that there is meaningful downward pressure on the valuation proposed under the alternative proposal. So again, the consortium, KKR, saw the financial year 22 results from Ramsey, and they did not like it, and they think that this puts a bit of pressure on this takeover bid offer. So what they're saying is Ramsay Health Care is not as valued or valuable than what they initially thought because of these financial year 22 results. So let's touch upon possibly why KKR think these financial year 22 results from Ramsay Health Care are negative. Now, after this updated proposal from KKR, share price closed at $62.94 on the September 13, which puts a market cap of Ramsay Health Care at $16 billion, which does seem pretty high, but the company did have revenue of $13.3 billion, profit $274 million, which does seem fairly low, particularly when you compare that to the market cap. And straight away, we're seeing a PE ratio quite high for the company that's not really growing all that much. Operating cash flow $715.5 million. And again, price to operating cash flow seems a little bit high for a company that is not growing all that much. So straight away, this is sort of an indication why KKR was not liking these financial year 22 results from Ramsay Health Care, with earnings per share of $1.16. And if you just compare that to the share price, you can see that the PE ratio of Ramsay Health Care is actually above 50. And usually see a PE ratio above 50 for a company that is growing at a fairly quick rate. And there is expectations that that growth will continue. Now, if we have a look at the growth in revenue for Ramsay Health Care over the past 10 years, this company's growth is slowing down. Now, this is revenue, but the revenue growth I'm showing here, 10-year, 5-year, and 3-year, is revenue growth per share, not overall revenue. For instance, if you look at the last 3 years, we have negative growth per share in revenue, but if you look at the overall revenue, it's actually growing. And the reason why we have a difference there between overall growth in revenue compared to the revenue per share growth is because this company has issued more shares. So even though it does look good in terms of revenue growth, when you look at revenue growth per share, it's actually negative over the past 3 years. Over the past 10 years, growing at 12% per year. Over the past 5 years, 5.4%. And over the last 3 years, negative 0.4%. So this company is slowing their growth in terms of revenue and also in terms of profit. So let's have a look at the profit growth in the next slide. So in this slide, we're looking at profit and also gross margins. And the first thing I take away from this is we have seen some pressure on profit over the past few years. So initially over this 10-year period, there was really good growth in profit from 2012 to 2017, 2018. That's the first year we saw profit fall. And remember, if you look at that chart, the long-term chart, we saw share price increasing for about the first 5 or 6 years. And then all of a sudden, share price started to go sideways. And that coincides with the period of time when profit stopped its growth profile. And one of the reasons why we have started to see a bit of pressure on profit over the last 5 years, even though revenue has grown and even though revenue per share has grown over the last 5 years, but not over the last 3 years, is because gross margins have fallen over the last 5 years. From 2012 to 2017, gross margins was fairly steady at around about 14%, but gross margins have fallen from 14% all the way down to just over 10%, and that has put pressure on profit on this company over the past few years. Now to the cash flow statement, and the next slide we'll look at the reconciliation of the cash flow statement. And the first thing I want to understand when I look at Ramsay Health Care's financial statements is why has operating cash flow fallen significantly from last year, from 1.5 billion to 715.5 billion, even though receipts of customers and revenue has grown from last year. And you can just see from the cash flow from operating activities that the main reason behind that is an increase in payments to suppliers and employees by about $700 million. There's also been some increases, very small increases in lease finance costs. But overall, this company did burn through a lot of cash during financial year 23 or 22. In fact, the cash on hand actually dropped from $1 billion to $314 million. And that's not negative, but I do want to understand why there has been a significant decrease in cash on hand over the past year for this company. And trying to understand why operating cash flow has dropped significantly over the past year, a good way to start is to have a look at the reconciliation of net profit after tax to net cash flow from operations. This is found in the notes. And the main thing I'm looking for here is changes in working capital. And there is some significant changes in working capital. So changes in working capital refer to receivables, payables, and inventories. This company doesn't have much inventories, so we really don't have to look at that. But there has been a significant change in receivables. In fact, last year it was 103.9 million. Now it's 664 million. So that is one reason why there's been a significant increase in receivables for this company, and not really any significant increase in anything else. So that's one of the main reasons why there has been a significant change and decrease in the operating cash flow for this company. The other thing to take into account here is when you compare profit for the year, 379 million, and operating cash flow, 715, there is a big difference there. And the main reason there is a big difference there between the two is because of depreciation, amortization, impairment, $921 million last year, $939 million this year. So this company does spend a lot of money in capital expenditure, that sort of thing. And it makes sense because they have a lot of hospitals out there, and to maintain hospitals, they do have to spend a lot of money. Now, if you look at working capital, in fact, in note 9, they actually spell it out. So trade and other receivables last year was 1.8 billion. Now it's 2.3 billion. Inventories hasn't changed all that much, and trade and other creditors hasn't changed all that much. So one of the main reasons, again, behind the shift in operating or change or decrease in operating cash flow is because of that trade and other receivables. And they actually mention in the presentation the movement in working capital is primarily the result of an increase in the trade and other receivables amounts as funding from the government grants provided under the French government revenue guarantee decree reduced. Now to the group's outlook and guidance. Not really any guidance here, so they haven't given us any numbers. And what I have found, and I think this is realized among many investors, is the outlook any guidance company gives in their financial year results is the main driving force behind the share price going higher or lower. A lot of people don't understand, a lot of investors don't understand this. They'll look at the results a company has released and they'll see some really good numbers. And the main thing is, have those numbers beaten, or were they lower than expectations? And that can drive the share price higher or lower. And also, you have to look at the outlook and guidance from the company. I have seen on occasion a company releases some pretty good results and then give a negative outlook, and reverse some pretty bad results and then give a really positive outlook. And that can drive the share price higher or lower, going in a different direction than you might think based off the financial year results. So it's really important to have a look at the outlook and any guidance a company will give for the next financial year, and possibly even the next few financial years. So Ramsay Health Care haven't really given us any guidance in their group outlook, but what you're looking for here is any sentiment. Is sentiment positive or negative from management? So the first comment here, they've mentioned they've invested $2.7 billion over the last 2 financial years to expand and upgrade its facilities. So again, this company spends a lot of money on capital expenditure for maintenance and for growth reasons. And in the second statement here, that they are expecting underlying earnings growth in financial year 23, benefiting from the additional capacity created the last few years. Their capital expenditure combined with full-year contributions from Elysium and recent acquisitions in Europe. So right now, we are expecting a little bit of growth in this company over the next few years, including financial year 23. But in saying that, they are still expecting some headwinds from COVID-19 and stuff like that, and also inflationary pressures on costs, increasing wages, that sort of thing. But the last comment here, Ramsey and their management believe the outlook for the group remains strong. So there is a bit of positive sentiment here. Our world-class hospital network, with combined with our outstanding people, give us confidence that the business is well placed to take advantage of the positive long-term dynamics driving the healthcare industry. We expect a gradual recovery through financial year 23 and more normalized conditions from 24 or financial year 24 onwards. So there is a bit of positive sentiment. And even though I do think this company does look a little bit overvalued based off financial year 23 numbers, I expect a significant rebound in their profit, in operating cash flow, if not in financial year 23, definitely in financial year 24. Now onto the valuation of Ramsay Health Care, and I think this is being a little bit unfair on the company because some of these valuation metrics do seem a little bit stretched based off their financial year 22 numbers, and I do expect a significant rebound in their profit and operating cash flow over the next few financial years. So these numbers do seem a little bit high. So you can't look at these numbers in isolation. I think if you looked at forward-looking P ratio, price to operating cash flow, those forward-looking numbers would be significantly lower than these backward-looking numbers. Anyway, P ratio 58.4, price to sales ratio 1.26, but I'm not really going to be looking or evaluating price to sales ratio for this company. And price to operating cash flow 23.5. So remember, this company produces significantly more operating cash flow than profit because of depreciation and amortization. That's going to continue really forever because this company spends a lot of money on capital expenditure for maintenance and also for growth. And one of the things I really do for many companies is look at the reverse DCF. So look at the current valuation of the company and what sort of growth a company should get to justify the current valuation. And if we do a reverse DCF for Ramsay Health Care, we get a growth in the numbers of 28% per year. This is based off the earnings per share, not free cash flow, because free cash flow, I think, was negative for Ramsay Health Care in the past year. But still, 28% per year over the next 10 years to justify the current valuations. I do expect a significant increase in their profit in operating cash flow in financial year 23 and financial year 24. And I think if we did that, we'd get significantly lower valuation metrics and probably a significantly lower reverse DCF as well. So even though these numbers do look a little bit high, I think you've got to look at these numbers with a grain of salt because I think they are high for a reason. And I do expect some really good growth for Ramsay Health Care over the next few years. Now to the daily chart for Ramsay Health Care, and this goes all the way back to March 2020. And the share price of Ramsay Health Care got down to about $46 during the COVID-19 financial panic. But if you look at the chart and the share price action from May 2020 to now, the share price of Ramsay Health Care has just gone sideways. A perfect consolidation chart here. And really the share price of Ramsay Health Care has traded between $74 to the upside and $60 to the downside. And the only time it has gone above the top of the trading range was because of that takeover bid back in April. Share price reached as high as $84. And then after that, you saw the share price just pull back. So this was the market telling us they were not confident that this takeover bid was going to be successful. And then on the latest update to this takeover bid, on the 13th of September, share price of Ramsay Health Care fell as low as $59.97. And $60 is a really strong support level for this company. About 5 times over the past 2 years, share price has fallen to that level, and then we have seen a good bounce. Back in January 2021, share price actually fell below $60 for about 4 trading days. That was looking a little bit dicey. That support level was going to be broken, but at that point in time, that support level was not that strong. It's now stronger because back in start of 2022, we saw Ramsay Health Care share price hit $60 twice, and then we saw a rebound on both of those occasions. So moving forward, $60 is a strong support level, a nice little buying price for those who are confident about the future of this company. And if the share price falls below $60, that would be a bearish sign moving forward. Now, moving forward, I have, at this point in time, not a lot of interest in taking the position in Ramsay Health Care just because of lack of growth in this company over the past few years. So even though this company was quickly growing from about 2009, 2017, doesn't mean a company will continue to be quickly growing. And we have seen a period now where the growth of this company has just gone sideways. And I would like to see a return to growth in the future. I do expect some good growth in this company in 2023, 2024, but that's on the back of some pretty bad growth or negative growth over the past few years. That's all I have for this video, looking at Ramsay Health Care, their financial year 22 results, and this takeover, possible takeover bid from KKR. If you have any thoughts, any questions, any opinions about Ramsay Health Care and also KKR and these takeover bids, these different proposals, I'd love to hear your thoughts. So leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.